Should you invest in 100% equities? Is 100% stock portfolio too aggressive? Putting all your money into stock is a daring investment strategy. Instead of diversifying across asset classes like stock, bonds, and cash, some people choose to invest entirely in equities, aiming for high growth due to historical high stock returns. The stock market's rise post-COVID-19 may make this appealing. This video examines historical stock market performance to determine if a 100% stock portfolio is a good idea. Welcome to holisticinvestment.in. Most investors might say equity is the best asset, especially since stock surged over 200% from the COVID-19 lows in March 2020. However, this isn't always true. Historical data shows no asset class consistently outperforms others. For example, from 2010 to 2021, gold outperformed equities during certain periods like 2013-14 and 2016-18. Therefore, it is wise to diversify rather than invest solely in stocks. Now, let us move on to some case studies. We will compare portfolios to show why asset allocation is essential even for long-term investors. First, 100% equity portfolio, high returns, high risk. Example, let us assume investing rupees 20,000 per month in the Nifty 50 index from 2008 to 2023. The outcome would be a large corpus of around 97 lakhs. However, the journey involves enduring significant market drops, say 30 to 40%, and testing investor patience. The lesson learned from this scenario is investing solely in equity can lead to emotional challenges during market volatility, prompting impulsive decision. Diversifying asset could have smoothened this journey, which we will explore in the next section. 70-30 portfolio, a balanced approach for long-term investor. 70% equity in Nifty 50 TRA and 30% debt in ISEC sovereign bond index over 15-year period starting from April 2008 to April 2023 with a monthly SIP of Rs 20,000. Annual rebalancing, maintain the 70-30 allocation aligning with the risk return goal. Final value 93 lakhs, slightly lower than the 97 lakhs of a 100% equity portfolio. Drawdown, fall in portfolio value. 100% equity portfolio had a maximum drawdown of 33.16% in 2020, while the 70-30 portfolio had a lower drawdown of 21.77%. Average drawdown over 15 year in 100% equity portfolio it is 11%. In 70-30 portfolio it's at 6%. Findings. The 70-30 portfolio offer reduced volatility and better downside protection, making it a strategic choice for a long-term wealth accumulation while navigating market turbulence. Next, 80-20 portfolio, balancing risk and return for growth. The 80-20 portfolio consists of 80% equity and 20% debt. Final value 94 lakhs, slightly less than the 97 lakhs for a 100% equity portfolio. During April 2020, the 80-20 portfolio mitigated losses better, reducing drawdown by 5 lakhs. Average drawdown over 15 years is 8%, better than the 11% of the 100% equity portfolio, but higher than the 6% of 70-30 portfolio. Findings. The 80-20 portfolio offers strong final returns while providing effective risk management and reduced volatility, making it a balanced choice for growth and risk protection. Next, 60-40 portfolio, prioritizing stability with moderate growth. The 60-40 portfolio allocates 60% to equity and 40% to debt. Final value slightly lower, 7 lakhs less than the 100% equity portfolio. During 2020 April, it provided excellent loss protection, limiting losses by 10 lakhs. Lowest drawdown in the category at 5%. Findings. This conservative portfolio offers greater stability and lower volatility. We have presented 3 asset allocation strategies to demonstrate how investment stability increases as you age. Ultimately, your choice depends on your risk tolerance, investment styles, and goals. Transitioning from aggressive to balanced portfolio over time is advisable, aligning with evolving financial needs and goals. Next, all equity investing potential and pitfalls. Investing entirely in equities can be both rewarding and risky. Equity investment involve buying shares of publicly traded companies, offering high potential returns over the long term, but also exposing investors to significant market volatility. The advantages of all equity investing is substantial growth and diverse opportunities. Historically, equities have outperformed other asset classes like bonds and cash over extended period. By investing in a range of companies across various sectors, investors can benefit from the growth of different industries and economic expansion. The risk involved in all equity investment is high volatility and lack of diversification. Equity markets are inherently volatile, influenced by economic factors, geopolitical events, and company-specific developments. This can lead to significant losses during market downturns or period of economic uncertainty. All equity portfolio lacks exposure to other asset classes like bond, gold, or real estate, increasing vulnerability to market risk. This lack of diversification can result in heightened volatility and potential losses during market downturns. Suitability of all equity portfolio. An all equity portfolio may not be suitable for investors with low risk tolerance or a short-term investment horizon. While equities can provide high returns over the long term, they also come with greater short-term volatility and the possibility of significant losses. Diversification is a key to manage risk and preserving capital, as different asset classes often exhibit low or negative correlation, offering a hedge against adverse market conditions. For most investors, a balanced approach that includes various asset classes can help achieve a more stable investment journey. Next, who should consider a 100% equity portfolio? While we generally do not recommend a 100% equity portfolio, some investors may want to explore this approach. Here is who might consider it. Long-term horizon. Investor with long-term investment horizon, typically 15 years or more, might consider a 100% equity portfolio. Historically, equities have shown strong growth potential over extended period, making them suitable for those who can endure market fluctuation over time. Next, very high risk tolerance and patience. Investing solely in equities involves significant volatility and the potential for substantial losses, especially during market downturns. Individuals with high risk tolerance and patience to withstand short-term portfolio fluctuation may be better suited for a 100% equity allocation. Next, diversification outside equities. Investors with diversified asset outside their equity portfolio may be more comfortable investing 100% of their equity allocation in stocks. Diversification across different asset classes such as bonds, real estate, and cash equivalents can help mitigate overall portfolio risk despite a concentrated equity allocation. Next, active monitoring and rebalancing. Those who actively monitor their investment and are willing to rebalance their portfolio periodically may better manage the risk associated with a 100% equity allocation. Here is the final takeaway. Investing is not just about making money. It's about achieving stability and balance in life, including prioritizing family and other important areas. While a 100% equity investment can offer higher returns, the commitment and effort required might exceed your expectations. Instead of focusing solely on maximizing profit, it is essential to consider other meaningful aspects of life. A well-diversified portfolio tailored to your age, risk tolerance, and investment time frame is generally wiser than going for all equity portfolio. This balanced approach allows for better risk management and protection against potential market downturns or unexpected events. By spreading investment across different asset classes like stocks, bonds, and real estate, you can achieve a more resilient portfolio that can withstand various market conditions. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.